Why would a buyer want to get pre-approved? Does a buyer have to put 20% down? Why would I talk to different banks about getting a home loan? Last week in this three-part series, we answered some of your questions, but we will have more answers for you today. So let's get down to the nitty-gritty. Hi, I'm Laura Clute with Ozark Gateway Realty, and I work with lakefront sellers who are animal owners. I'm here with Michele Linehan, the Senior Mortgage Loan Originator at Centennial Bank. Michele, what are some lending questions that you hear a lot?
Well, one of them is, what about the different programs?
Right.
What makes the buyer choose one loan program over another? Say you're a veteran. Why would you choose to do VA over, say, FHA or a conventional loan? And there are a lot of programs out there. A conventional mortgage is the one that's kind of I call it the plain vanilla loan. Generally speaking, people think of it as 20% down. You don't have any mortgage insurance, which we'll go into, things like that. And then we have other different programs. FHA requires a very low down payment. VA requires no down payment. In our area, we have a USDA, which is a Department of Agriculture program called Rural Development, which requires no down payment. And of course, conventional mortgages have changed over the years. So if you're a first-time buyer, you can use a conventional loan with as little as 3% down. And the advantage to that is on FHA, where you have an upfront mortgage insurance premium along with a monthly. This can get rid of that upfront, and the monthly can sometimes be less, especially if you have great credit. So that's something that your loan officer is going to help you figure out. What's the best program for me? We have a great program called Mortgage Coach, and it'll actually show you graphs that we can set this up for our buyers, and they can pick the programs that they think they'd be interested in. We can input that information, and we can show them in a visual picture how that looks. So is your payment lower? What about over time? Are you paying less over time, or is it actually more expensive? And
Right.
It helps them get a better idea of what it's going to look like in the short run and the long run. So, and if you're going to stay in a house 10 years, you kind of want to know that. You want to know what your equity position is going to look like, especially if you're a first-time buyer and this is your first home and you want to hold on to it for a while, develop some equity, and then be able to move on to something bigger and better. So it gives you a really good idea. And on the topic of mortgage insurance, there are several different ways that lenders refer to this. Either private mortgage insurance, or in rural development terms, they call it an annual fee and a funding fee. And what those are insurance that protects the lender. So they're protecting the lender if you put down less than 20% and should default on that loan. So you're paying a premium every month, just like you would with car insurance or your homeowner's insurance, as protection for you to not have to put down a big down payment. And they're all structured a little differently. VA charges a funding fee, and it's a one-time fee.
Okay.
And it can be waived if veterans have some kind of disability rating from VA. So they don't all have to pay it. And it's different whether you're using it the first time or you're reusing your VA loan. So that varies, and it's added into your loan amount. So that it's a little different. Rural Development charges an upfront fee, and they also charge a monthly fee. FHA charges an upfront fee, and they also charge a monthly fee. And then on a conventional loan, you pay nothing up front, but you do pay that monthly mortgage insurance premium. So, and then they all have different parameters of when they go away. So that's something that you want to discuss with your mortgage loan officer so that you understand how it works for that program, what it's going to cost you, and if and when it goes away.
Yeah, I didn't realize that my first home loan was a rural development loan, and I didn't realize I was paying a monthly fee for that mortgage insurance.
Yep. And a lot of people, they just kind of gloss over that. And I think you and I are the same, Laura. We're kind of frugal. And I don't want to pay more money than I have to for something, but I do want to understand what I am paying and why I'm paying it.
Yes, definitely.
And that
was
kind of, go ahead.
I would just that a lot of people think a first-time home buyer means literally your first home. Actually can mean that you've already purchased a home and it's been, what is it, 3 years?
3 years. If
Okay.
you have not owned a home for 3 years, you are considered a first-time home buyer. There's also an exception for mobile homes.
Huh.
If you own a mobile home and you want to buy a conventional stick-built home, they also consider you a first-time buyer. So there's a little kind of caveat on that.
Yeah,
which is nice.
Yeah,
and
definitely.
along with that, pardon me?
It's a move up.
Yeah, exactly. It is a move up. And I have owned a mobile home myself, and I think they get kind of a bad rap.
They do.
I'm not saying that they're the greatest thing in the world. They've changed a lot over the years. I think they've even improved more. So I think that
Yes, I gotcha.
Okay.
You were just saying how mobile homes tend to not have a good name but they've been improved much over the years.
Yes, they have. And then we've talked about mortgage insurance, and another thing people frequently ask about is what exactly is an escrow account?
Right.
So an escrow account is when your investor collects your taxes and insurance as part of your mortgage and then deposits that into a separate account, which they call an escrow account, and they pay your tax and insurance for you once a year. And if you're paying private mortgage insurance, that is also going into that escrow account.
Okay.
So you get a separate accounting on that once a year where they show you what they've collected, where they've paid it out, and then if you have any changes, if your taxes or insurance have gone up, they'll make the appropriate adjustments. That account is required on some types of loans, and it's required on conventional mortgages when you put down less than 20%.
Okay.
You might opt to get one anyway, because in my world, you get just a slightly better interest rate if you allow the investor to set up that escrow account. So the escrow account guarantees them that you're not going to accidentally go into default because you forget to pay your taxes and your insurance,
right,
or you're out of town, or you're sick, or for whatever reason. So it's just added kind of insurance for them, and
right,
you can benefit from that, which I mean, I've had an escrow account on every one of my loans, and I wouldn't do it any other way. And it doesn't mean you can't change your insurance company.
Exactly.
You get to shop for your homeowner's insurance, and if you opt to change, it's a pretty easy process, and we're there for you. If you have questions about that, that's the kind of thing that you want to use a loan officer that is around. You can come in my office and say, Michele, I got this statement, I don't understand it, or I want to change my insurance, I'm not sure what to do. And we're there to help you.
So, of course, when you get a home loan, unfortunately, you have to pay interest.
Yes, you do.
How would a lender decide what interest rate they're going to charge? And since we are in a kind of a higher interest rate time period, lots of people are talking about locking in interest rates.
Yes. So we are in a higher rate interest period, and it's probably going to continue to go up a little bit. And that's the bad news. The good news is it will eventually come down, and you always have the option to refinance. So rates are determined on your credit score, the loan to value. So in other words, what percentage of money you're borrowing, the property type, whether you're buying a single family dwelling, a multifamily dwelling, is it a primary, a second home, an investment property? So all those things affect your rate, and that's something that you want to look at. And then when people talk about rate, they also, if they're smart, are going to ask about points.
Right.
So what we call bona fide points are used to lower your interest rate. So you pay a percentage of the loan amount, and it actually will lower your rate, which in turn lowers your payment. So on a fixed rate loan, if you're going to retain that property for a generous period of time, you might want to think about doing that. And it's something that you want to talk to your loan officer about. I always we give a variety of rates to our clients, and we help them work through the process of, okay, if you do this, it's going to cost this much. If you do this, you don't have to pay any points. We actually, if we get any money back from an investor, if we're going to transfer the servicing on that loan, pass it on to our client, most banks keep that as part of their profit. That's always been the way I had worked before.
Okay.
So that's kind of a little perk. So every once in a while, you're going to get a rate where you're actually going to get money back as a credit from us, which is kind of cool.
Yeah.
Right now, that's pretty rare because the way that the rates are going, investors have been cautious to push rates up to the point that they really should be at, just because it's not very palatable for people. You know, we were down in the 3s, now we're
Right.
at 7, and it
Right.
sounds kind of scary. So they're trying to keep a rein on them as much as they can. So
Right.
a lot of times you're going to see points on loans, although in the last couple of weeks we've seen them get a little bit better. So, you know, you're going to see that up and down, up and down, up and down. Normally people don't lock their rate until after they identify a property.
Right.
We do have a program where you can lock in your rate earlier, and you know, you're welcome to call and discuss that with us. But normally your rate follows the property. That's been pretty much the norm in the industry, but we do have a special program right now where you can go ahead and lock your rate in early. So there are different options for people. That might go away. I don't know that it'll stay around long, just because of the way the market's moving.
Right.
It's risky in an increasing rate market for a lender to do that. So
Right. Definitely.
Today we gave you more details about the home buying process. Next time we'll talk more about why different banks may be better suited for you. If you missed the first part of the series, here's a video where we talk about pre-qualification and pre-approval. See you next time!